So good evening, everyone, and welcome to tonight's Master Your Intraday Trading webinar. Before we start, I'd like to draw your attention to the disclaimer on screen that I'll read for you now. All information that is provided during this seminar is for educational purposes only. The presenter is not a financial or investment advisor and is not authorized to provide recommendations on any instrument of any kind as part of this presentation. The strategies showcased are applied on hypothetical scenarios. Any instruments that are mentioned throughout are cited for illustrative and educational purposes. The webinar is not intended to be a personal recommendation and must not be construed as advice from the presenter. Pepperstone doesn't represent that the material provided here is accurate, current or complete, and therefore shouldn't be relied upon as such. The information provided here, whether from a third party or not, isn't to be considered as a recommendation or an offer to buy or sell, or the solicitation of an offer to buy or sell any security, financial product or instrument, or to participate in any particular trading strategy. We advise listeners of this content to seek their own advice. So it's really good to be back with this Master Your Intraday Trading webinar. Obviously lots going on at the moment, so I'll go straight on to a slightly different format now that we've returned. We're going to run for an hour tonight. We're going to try and really focus on that intraday trading, providing you with some real-time what's going on with the market right now. And as you can see from the screen, there's nothing more real-time than what's going on with the dollar, especially the fact that we have the Fed announcement in about half an hour's time. So Morris he's going to talk about what's going on with the dollar, and then he'll be able to update on any questions, tell us what's going on, what's happened with the Fed when they speak after 7 o'clock announcement. Then he's going to pass over to Richard Adcock, who's going to focus on how he uses price activity for the short-term trading, and he's going to focus on Aussie, Euro, and also the S&P tonight. Then he's going to pass over to Roger, who's going to discuss setting your trading goals and how you measure your success. So as always, please put your questions, if you have any, on the chat the minute that they pop into your head, and we will try and do our best to answer as many as we can by the end of this presentation. So Morris, over to you.
Hey Chris, thanks very much. Welcome everybody. So I think we've got quite an interesting market in front of us at the moment, and right now there's a couple of distinct themes. One is the recovery story, which could see the dollar move up. You know, some of the ideas behind that we've put here on the left hand side. The idea is that global economies bounce back with some form of some shaped recovery, and within that, I think, you know, we'd have vaccines putting an end to the lockdowns, service sectors that have been hardest hits recovering, social mobility starts to improve, and, you know, consumers start spending, so that's economic growth recovers. Inflation starts to show a little bit, so yields rise, and that gives us a sort of an idea that we might see the dollar, if the US is one of the first to recover, sort of do fairly well in that scenario. On the other side of the scale, we need to look at what's going on with keeping potentially the dollar down, and that would be probably a massive sort of fiscal stimulus still going, but with the Fed still holding rates low. And remember, they're meeting tonight. We don't expect anything on the announcement on rates tonight, but it will be interesting to see what Powell says. He starts talking at 7:30 London time. That's in just about an hour, just as we're finishing. So I will be going over in slides later on what we may expect from him. So I think the danger here is that we don't get the fiscal stimulus coming through necessarily on time. Vaccines potentially take longer to roll out. We're seeing that in the EU at the moment, which is really sort of dragging, I think, on the EU economy and indeed the euro, to be honest, especially what we've seen today. So, you know, those sectors hardest hit by the lockdown restrictions would continue to suffer. Unemployment would stay high. You know, yields would we'd probably get a risk-off scenario with that, which would suggest that yields start going down quite a bit. It'd be interesting to see what the dollar does, because the correlation between risk on, that's equity markets going up, and dollar going down seems to be breaking, which I'll show you in another slide in a moment. But if economic growth does falter, there's going to be concerns coming in that instead of a V-shape or U-shape recovery, we get this W shape where we go back into a double dip recession. Very much looks like we could see that in Europe at the moment. So that is a concern for Europe. I think the countries that get out of this problem or crisis first will be rewarded with capital inflows. Their currencies will do better, and their assets like their equity markets will do better than those that are slow. So right now, central bank policy does remain extremely accommodative. This has been sort of the driver for the lower dollar view that we had into the start of 2021. But to be honest, that dollar has become much more mixed in the last, well, since we got into the new year, to be honest, and we've actually seen a fair bit of strength, which again, we'll show on another slide. But the idea is that if we get this breakdown, then the Fed stays with its foot hard on the floor, on the gas pedal, and that would be a further debasement for the dollar, and the dollar theme would be back down again. So we're a bit mixed here. We've got quite a lot of moves on the risk markets. So I think, you know, what we can do is highlight what the recovery story should look like. Now, on the screen in front of you now, this is the Russell Index from the US. Now, this is small cap equities. Now, as you can see, you know, where we see the recovery coming in here from the 1st of November there, the bottom blue arrow, we've seen the recovery see almost a rotation from big tech names, all the big stay-at-home stocks were unwound, and these lesser wanted value stocks, if you like, in the Russell small caps that had been out of favor for so long through the dark days of March, April, May, and June, all the way through into the winter, suddenly started to gain traction. And that's quite an impressive chart about what we're seeing. Now, interesting, this chart is up to date, and we're actually seeing a bit of a rollover on this index today. So interesting to watch this here, because we're running up against this support level. So it'd be interesting to see how stocks close tonight. On the other side of your screen here, we've now got the 10-year yield. This is the yield, not the price of the bond. So as prices of bonds go down, yields go up. This is the 10-year yield. And you can see that what happens when we start looking at a reflation story, or the recovery story, if you like, that we start to see yields increase. Now, interestingly, up until the end of this year, if we'd have seen stocks go up, we'd have seen the dollar go down. But what's happened here is that because the recovery story is starting to price in inflation as well, we're seeing yields go up and stocks go up to a little bit of a degree, and therefore holding the dollar up as well. So if you look at the 1st of November on the Russell Index, and then look at the 1st of November on the 10-year Treasury, you could see that they started going up in tandem. We had a dip, and then on the 3rd of Jan, we started going up again on yields and up again on the recovery story. So this shows you that these correlations between the dollar and the stock market are not pure. So they can break. And the recovery story is a different recovery from a risk-on story in a market that traders or investors still believe is going to be slow to recover. So this has been a change that we've seen recently, and I think it's quite interesting, and I think that's a very good visual for you to see there. So on the recovery story, what else do we need to watch? Well, the dollar, you know, it is a little confusing. This is the dollar index you can see on the chart there. From the 18th of Jan, we started coming down. We've hit a bit of a base. Now, we almost held perfectly on this support line that you can see there. That was quite interesting, but the issue is that we turned as yields started to move back up towards 10-year yields in the US around 1.2%, saw this dollar go up. But the other thing that you must remember about this this dollar index is that the euro in the DXY is 55% of the index. So obviously moves in the euro that could be just a Eurocentric issue can have quite an impact on the DXY. There are other indexes out there. The Bloomberg dollar index is slightly broader, and you can look at trade weighted euro as well, which actually is quite strong as well. But I think realistically, this just shows you that we've seen this bounce as yields have gone up, but also we're seeing a bit of a bounce today as we've got problems stacking up for the Eurozone. Now, in the Eurozone, we're seeing what it can only be called a bit of a disaster with getting these vaccines out there. And whilst the UK has vaccinated about 11 people per 100, the EU has done 2. Not good enough. They haggled over the price, they've haggled over delivery times. They took 3 months to get their deliveries sorted out or dealt with by the vaccine suppliers over and above the US and the UK, which is pretty shocking. So, you know, yet again, EU bureaucracy getting in the way of common sense. The danger here now is this double dip recession could be real. I think the ECB is aware of this, and the pandemic is enforcing further lockdowns. We still could hear more from France and Germany on this. So service sectors getting hit very hard in the EU as well. It does look pretty bad, possibly even worse than the UK, which is not looking great at the moment either. It's not just about the numbers, it's about the economic impact, unemployment and things like that. So the EU desperately needs this fiscal boost that is supposed to be coming from the joint bond agreed back in last May. They still haven't got this money out there. There is talk that even the way to spend it hasn't been agreed yet, and they don't expect that till April. So this relief package, whilst the UK is doing something on a regular basis, the US is about to agree $1 to $1.9 trillion worth of recovery bill. You know, they're stopgap bills, but they're doing something. The EU is still not ready. And I think that's why we're seeing some of this euro weakness. And we saw a pretty decent sell-off in the DAX at one point today. And I think that again is on the back of this. So, you know, the interesting thing here as well, looking at the dollar index and the large component that euro is in that, is that the ECB seems to be concerned about euro strength now, particularly against the dollar. So I think realistically, the market ignored this when they first mentioned this. There was a couple of statements came out from Knott, a couple of statements from Lane a few weeks ago, Knott again today. He was suggesting that you know, the market wasn't taking enough notice about the fact they wanted to study the impact of the ECB versus Fed policies. And whilst the euro is up 9% in 2020, they're not happy with that. And Knott actually said today that he believed that the market wasn't taking enough notice that the ECB could cut rates further. That's when the euro started to move. And I think for them, no one thought they were going to cut rates again. I mean, they're already deeply in negative, and to cut them further, I think would be, well, I don't know, but it would suggest that they are moving policy to target the euro. I think the Americans and a few others will have a lot to say about that. And you know, what we don't want to get into in the middle of a pandemic is a currency war. And from currency wars, unfortunately, we usually see trade wars. So this is not helpful, and I think that's why the euro got hit today. We need to keep an eye on that. But you know, we do have some you know, ongoing fiscal stimulus story that could help the recovery into the end of the summer, maybe. The relief package from the US, I've written down here what it involves. You've seen this before, hopefully. The person on the street is suggested to get $1,400 on top of the $600 they approved in December. The only thing with this is that there is a danger that they don't get this passed. The Republicans, don't forget, hold 50 seats in the Senate, and so do the Democrats. The casting vote is Kamala Harris, who's a Democrat, of course, vice president. But you know, the Democrats only need 1 or 2 Democrats to pull out of this, and they could struggle to get this through. So there may be some horse trading on this, and it may not be 1.9 trillion, and it may not go to all the places they want it to go to. So be careful of that, because I think the market's very sensitive to this sort of thing. The new Treasury Secretary, Yellen, ex-Fed chairperson, beg your pardon, she said, the president nor I propose this package without an application for the country's debt burden, an appreciation, sorry, of the country's debt burden. Now, that's all very well, but out the other side of her mouth, she said that the smartest thing we do is act big. So it's all very well, this idea that they're going to pay this money back, but with debt the size of it is, goodness knows what they're going to have to do to taxes to get this paid back. I don't think this will be an issue for a while, but I can't see them paying back this debt. Well, not in my lifetime anyway. But Yellen did say her task will be twofold, but there is, you know, final months of the year. But I think realistically, there was further news that Biden is now talking about a secondary plan. I think he's trying to get this into February, between February and April, about a much broader package, because the package they're suggesting now, the 1.9 trillion, is just a relief package. It is a plaster, it is not a stimulus. The stimulus would come if he can get a package passed, which will be difficult, for infrastructure spending, green credentials, which they're looking to chase, childcare, manufacturing, trying to get the things that need doing, putting in place that actually have a return on the capital spent. The relief package they're giving people is short term. There is not much long-term return on that money, I'm afraid. It will be spent, yes, that's great for the economy in the short term. So it'll be interesting to see if this Fed policy is enough to keep the dollar weak. I mean, he's going to be challenged on this tonight. So I do think realistically he's going to be asked some big questions tonight. Now he's going to be asked about whether he's going to be keeping his foot on the floor. That means are you going to carry on buying bonds at the level you're buying them at now, or are you going to reduce that buying? That's called tapering. If he reduces the buying, if he mentions, yes, we are considering tapering, that would be quite a, I think you'd see stocks fall on that. I don't think he's going to do that though. I think he's prepared to keep his foot down on the accelerator until unemployment comes down. Inflation is moving up to where their targets are, and that could take some time. And remember, both he and Clarida, his vice chairman, have walked back the idea of tapering soon. But I'm just wondering if they might be suggesting that the discussion is taking place out there at the Fed on the committee. So I do think it depends on data improving, but I think you'll see him try and hold things stable or steady at this meeting. I don't think he wants to make any changes to this, but he's also going to be asked questions about frothy stock markets and things like that with what we've seen in some of the single stocks that have been going on recently, and the investor euphoria, if you like, that we're seeing in some of these stock markets, and in particular, some of the very small stocks that you may have heard about, you know, rising 200 or 300% in a session, which is akin to the dot-com bubble, because some of those companies aren't worth a light. So right now, investors are looking to the summer for a combination of the vaccine doing its job and the arrival of significant support packages. But will the Fed concentrate on that, like the markets are, or are they dealing with the now and we need to get through this virus before they make any changes? And I think that's probably the line they may take. I think they will want to see more. So there's a real danger that the date of the recovery is pushed back, though, by these lockdowns and these the vaccines sort of slow to kick back. But I do think the Fed is looking at the danger of that the recovery not happening on time, and so that just may hold them back on a few things here. So I do think it's very interesting what the Fed says tonight. He starts speaking at 7:30 in about 45 minutes. I think he will be asked some tough questions. I don't think they'll do anything with rates at 7 o'clock, but I do think we're in for some. I think there's volatility in this market now, and I think that in itself could be a little bit destabilizing. So I think we need to be very careful. On that note, I think we need to sort of concentrate on the technicals, and I'm going to pass you over to Richard, who's going to talk to you about short-term trading tonight. Rich?
Thanks, Mo. Good evening, everybody. Hope you've had a great week so far. What I wanted to do tonight was take a look at some of the support and resistance levels that we looked at in the Sunday night webinar, and just gauge how they affected trading to begin this week and how they developed within trading opportunities over the last couple of days. So I'm going to start with the Aussie US dollar, where if we look at the current chart that we've got up here, this effectively was how we looked at the cross on Sunday night, having seen Friday's close. And our focus was basically the development of Aussie underperformance, because we were looking at Aussie scores, smooth scores continuing to fall, and US dollar improvement as US dollar scores and ranking levels were improving, to suggest that we could perhaps see risks of Aussie US downside developing. But we looked at a couple of pretty clear support and resistance levels marked by Fibonacci retracement. The support level that we tested on Friday night was this 7704 level, which was the 62% retracement of the latest recovery. And resistance was marked by 7743, which was the 50% retracement point. So just looking at the 4-hourly chart that we have here, what I want to do is just see how these support and resistance levels reacted and prompted price activity to see how actually the trade developed. Now, effectively, we were looking at Friday's close of having tested a support point, but with the resistance at 77.43 still intact. So with the general backdrop of risks for Aussie underperformance, we were looking effectively for rallies back towards resistance areas as beginning to stall and encounter fresh selling pressure. So as the week began, we continued to see the 62% retracement support holding activity until we started to see a more sustained recovery developing on an intraday perspective. And as you can see, that this actually took us back towards the 50% retracement point as the session evolved. Now, the general backdrop that we have from the technicals is that we're looking at strength as a selling opportunity, with the main resistance being this 50% retracement level. So effectively, we're looking to use a recovery as an opportunity to open short positions, looking for fresh downside to materialize. And as we've said, the resistance focus is this 50% retracement point. So we're looking to establish shorts against that area. So we can see that having seen the sharp rally from the support, we move back towards this resistance area, and we would then naturally look for selling pressure to evolve and downside risks to develop. Now, having seen that recovery and further attempts to push higher, within the next 4-hourly period, we started to see more serious selling pressure developing and the market retreat and approach again the 62% retracement point. We even saw a break below that level, and the market actually closed the 4-hour period above the 77.04 retracement support. So effectively, what we're seeing within this period of activity is confirmation of the resistance around this higher retracement point, the development of more negative themes as the selling pressure evolves, and the pressure and potential break of the support point that we've highlighted at 77.04, which develops negative themes even further. So as this activity develops, we start to see still a short-term recovery, followed by further selling pressure that sees extension of the decline and a more aggressive sell-off until we start to trade towards the 76.70 low, from which a more sustained recovery developed. Now, this is important, this point here, because we'd already looked at on the daily chart as the important support area being the lower limits of this consolidation evident within the daily chart. So this line actually stood at the time at the 76.73 level. So effectively, this is the important point that I try and stress for those trading from a shorter term perspective. You always need to be aware of the longer term support and resistance levels evident on daily and even weekly charts. So we knew from the daily perspective that this uptrend at 76.73 was an important support level and a potential rejection point if the market traded to that point. So as we can see within the 4-hourly chart, as we flip back, having tested that very strong support, daily support level, we would perhaps be looking to reduce short positions, having established them against this initial resistance area, looking for the potential of a recovery and a reaction to this sell-off because we've tested such an important daily support. The subsequent rally, I must admit, did carry further than I anticipated, but we can see that the move back towards these previous highs and back towards the resistance has started to see failure and rejection developing again. So subsequently, what we've seen materialize within the latest trade is the market selling off and rejecting again, breaking below this daily support at around the 67.70 level, sorry, the 76.70 level, and accelerate to the downside back towards the trend line support evident on an hourly trading basis. So again, we've tested a support point at the downside, and the important focus for me tonight would be the 76.70 area on a closing basis. So if we close below that point, the risks would turn towards a more extended decline, because this area within the daily perspective would be looking to be more of a serious distribution area, and the potential for a more extended retracement of what has been a fairly significant phase of Aussie outperformance and dollar underperformance within that type of activity. So again, we would then bring in the Fibonacci retracements as potential levels on longer term support points within the daily perspective, with the 38% level being just above the 75 figure. So effectively, the important point that we need to take from this activity is that the deterioration within the Aussie was reflected within the deterioration within scores, and that first started to develop within the shorter term 4-hourly perspective. However, we need to be aware of the significant daily supports in this case, because that would prompt the potential for a more extended recovery, or at least a recovery, as this choppy sideways trading area develops. Now, if we start to break below this level now, this is looking to be a more serious negative shift in sentiment and the potential of a more extended sell-off developing. Okay, so that's the Aussie US. If we now look at the Euro US dollar, the picture that we looked at on Friday night for the daily perspective was that the market, having sold off, had tested this 120.64 retracement point, which is the 38% retracement of the November-January advance. So we know that we'd hit an important and strong retracement and support level. And the previous week had actually seen a recovery and rally back towards the 38% retracement level, as we can see within this daily chart here. Now again, referring back to the rankings levels and the scores, the euro was ranked 10th within G10, so the weakest technically based currency within G10 at that time, against the US dollar, which was seeing rising scores and continuing to move higher within our rankings table. So the fact that we were back towards the resistance area within what is still a negative euro backdrop prompted us to look for this region to act as a resistance point. And we can see subsequently that, again, the market has sold off and started to see retests of this support point marked by the first retracement level. But within the shorter term perspective, the important signals began to develop as the market started to encounter selling pressure. Now, the first support point that we were monitoring within the 4-hourly chart was this low point here and around the 121.50 area. And effectively, we were saying that because of the general scores and rankings backdrop, if we start to see that level giving way, it would reflect deterioration within the overall structure of euro dollar and the risk of a more extended sell-off developing again. Well, we can see that subsequent trade extended the consolidation area, but still above this important support point. So we were still looking at a consolidation above a support with no new technical signals materializing. But as soon as we started to see selling pressure developing that broke below this low, again with the rankings and score backdrop that we spoke about on Sunday night, there was the first sign of a more serious deterioration and the risk of downside resumption within the euro dollar that we were highlighting within the daily perspective. So effectively, the break from the shorter term view of support was a trigger for the potential for further downside to develop and the risk for a sell-off to occur with stops just above the recent highs. So we can see that the marketing started to encounter selling pressure, a move that retested the 62% Fibonacci retracement point of the latest recovery from which a rally developed. But still, we remained below these previous highs. So effectively, the rally from this 62% retracement point, which was a support focus on a 4-hourly basis, saw the market rally back, but then really fail again at resistance, from which the market has subsequently seen selling pressure develop today. And as we've seen within the daily chart, the risk is that we're now back towards the 38% Fibonacci retracement support. And really, this is going to be a very important focus for tonight as we go into the Fed and the announcement and the reaction to it. Now, I can't say what the Fed are going to say and how the reaction is going to be, but the important point is that we now use the shorter term and particularly longer term charts to highlight where the important support and resistance focuses have to be. And if we do start to see these levels giving way, then it would reflect further technical signals and the potential of a more sustained move. Now, the sell-off that we've seen today may just be squaring of positions, preparing for what people anticipate the Fed may say, or it may be something more significant. But that won't be confirmed until we start to see a close below 120.64, which could, within the daily perspective, be a trigger for a much more extended retracement, potentially down towards the 119.76, which is the 50% level, possibly even the 62% level at 118.88. So over the Fed tonight, my focus will be on 120.64 as the important support level and how the market defends that on a closing basis tonight. Now, in terms of how we're looking at the shorter term view, obviously having seen this sharp sell-off occur, I would then be looking to run the retracements on this latest sell-off to highlight the more significant levels to monitor within this price action and any recovery as the market pulls back, if it pulls back in the initial reaction to the FOMC. The 50% retracement point just under the 120.120 level for me would be a focus within a more prolonged recovery, but still looking again at this Fibonacci retracement on a closing basis because the risks would be for a more serious deterioration and a deeper sell-off to occur. Now, also ahead of the Fed, what I want to do is to take a look at the S&P index and see where we stand within that particular structure. Now, this is the daily chart, and we can see that that support point that we were monitoring offered by this last correction low and the midpoint, the 50% retracement of this latest rally at 38.05 is now being pressured within today's selling pressure. So for me, technically, this is a concern and is an indication that something could be changing within the overall structure of the market. Now, if I look at Bollinger Bands within latest price action and effectively say, well, we know that the mid-average of Bollinger Band on a closing basis has held previous corrections, then we need to watch this on a closing basis. So this mid-average support on a daily basis for the S&P is the equivalent of that support level, that retracement point, if you like, for euro dollar. You know, stocks coming off, as Mo has told us previously, stocks coming off is supportive for the US dollar. So if we do start to see closes under this midpoint, we know that the risk is that that could boost further the US dollar activity and potentially see the likes of euro dollar and Aussie dollar breaking the important support points that we've looked at. So again, the important focus is this mid-average of Bollinger Bands and a close below that tonight, which stands around the 37.94 area. So that again is the focus that we need to monitor tonight. And if that's broken on a closing basis, it would suggest a more serious technical deterioration and the risk of a more extended developing over the next sort of few sessions. So within the 4-hourly chart, we can see that the overall structure is still looking to be breaking below these retracement and this last correction low, again highlighting deterioration. But I think it's more the daily perspective that's the important monitor and how we defend this mid-average support and whether or not that starts to give way either tonight or over the next few sessions. Because as you can see, we've broken below it on an intraday basis, but have always closed above this level. A break below that point would suggest a more serious deterioration and the risk of an extended sell-off developing for stocks, which we believe would be supportive or potentially supportive for US dollar strength. So that's the technical backdrop. We'll take a look at the reaction to the Fed and we'll cover that more on Sunday night. But for now, I'm going to hand over to Roger, who's going to look at setting your trading goals and measuring your success. Thanks very much, Roger.
Thanks, Richard, and good evening to everybody. I appreciate the heading of this this webinar was intraday trading, and we're certainly going to start looking at some intraday trading strategies over the next few weeks. But I thought it was very worthwhile just setting our stall individually in terms of what trading means to us and how it fits into our lives. And one of the key reasons we do this is because even if you're a short-term trader and your style is to basically log on and be buying and selling, pure momentum trading, you will come under stresses and strains, and at times it can be very, very addictive. Whether you're chasing the market or you believe that you're on a good run and you want to keep trading, it can be very, very addictive. And similarly, if you start looking at slightly more longer term trading where you're using those charts for kind of future target areas and playing out the life cycle of a move and trends, equally, people can get married to those trades. And I remember back in the day, before we all had online phones, etc., we had Reuters pages, and I'd see my traders, constantly pressing the buttons, even while they might be standing outside a pub, just checking where the rates are because they've still got risk in the marketplace, and it became an addiction that they constantly had to know where markets are. So it's very, very important that this is going to produce stress points, and I think that the piece I'm going to go through now just hopefully sets our stall and helps us perform better because we actually feel we're in a good space and we're doing what we actually should be doing. So I'm just going to run through a little exercise, and this is something maybe we could all do, we should all do maybe, and I just want to make sure that trading has the right balance in our lives, and that will be very, very individual. And how do we go about this? This was an exercise I did when I had big work-life issues where I was just spending so much time at work and very, very little time with the family. And some can argue that's because you're trying to achieve goals, but there was an imbalance, and I had to address it. And I wouldn't want other people to get into that, whether it be around your work-life balance or just where trading can actually be, pushing too much or too little into your life. So just a few quick questions that I'd like us all to ask ourselves is, how much of my time is actually spent trading? And does that reflect my expectations in this space? If I'm only looking to make £100 a day out of trading, should I be sitting there trading for 6-7 hours? Suggests not to me, suggests you're either doing it wrong or you start getting hungrier, and you're over trading in comparison to your expectations. And clearly linked into that is your overall bottom line. If you do want to spend 5-6 hours trading every single day, and at the end of the week, on an average, you're still only making £100, then something's probably wrong there a little bit, and the balance is certainly wrong in terms of those hours spent. And we'll see some of the implications that can have. And clearly one of the big ones is, does that impact on my other responsibilities? So this quick exercise is really just to try and create your own kind of wheel of life as such, and all those elements that take up your day. And this is just a mock-up, and everybody's will be different. And one of the key things as we've gone through this pandemic and we're all working from home and school, homeschooling, etc. How do you keep in touch with your family and friends in this difficult period, and where does your trading sit within that? And so this has probably changed over the 2020, the pandemic year, and leading into 2021. Certainly for me, it would look different to this. My hobbies, luckily retired, my hobbies would be a bigger segment, but all of a sudden that's been squeezed because of the pandemic. So I should be taking a look at how I use my time. But If I focus more on, people that are trading, the one key thing here is to work out from your expectations of your trading is how much of your time you think should be in that brown segment allocated to trading. The musts, from me, if I can pass on any advice, the musts clearly are that time spent with family and friends, and I think that's been highlighted by the last 15 or the 12 to 15 months that we're having. And hobbies are good for us. Hobbies are interests. They keep our mind going. There's something where there should be a little bit less pressure on us and something that we can really, really enjoy. And obviously work, carries its own burdens, and, some people will have more pressures and different time segments around work. So build your own one. And for me, unless you're looking to trade professionally, and trading blurs into that work element, that trading piece is the piece that probably should adapt a bit more than others, depending on what you want to do within trading and what you expect out of it. So try and be honest about where this is. And if you feel at the moment it's wrong, then what we've actually got to do is work towards getting it to where it should be. That's an important exercise in itself. But if we just focus on the trading element, one of the key things here is if you answer those questions and you realize you are trading for long periods and not making much money, or your expectations are quite low in this space, then possibly, the brown segment may be too big for you. Are you over trading in that? Similarly, if you've got a bigger appetite, in terms of your bottom line, and you're only spending a short period of time in it, maybe your expectations are wrong, given the amount of time you either do allocate to it or you're able to allocate because of pressures coming from all those other segments. So, I think if we answer this correctly and get this segment right, we will avoid over trading or indeed inertia. We will have better control of our emotions. This is a key thing for me. If we know we're trading at this point in time, and to a point, we've actually given ourselves license to trade for this amount of time per day or whatever, we'll feel good about ourselves. We're not doing anything naughty as such. We'll be able to control our emotions, and I think our performance will improve from that. One other key thing is I think you'll enjoy and benefit from the time spent away from it, because you're doing the right thing. You've gone through this process. You're not missing anything, or even if you're missing a move, when you go back to it and you feel it's the right time to do it, and you've saying to yourself, right now I've got 4 hours where I can really focus on my trading, I think you'll get better performance out of it, because you won't be worried about missing something, because in actual fact, this wheel told you, actually, this is not my time. I'm not saying that your time is between 9 o'clock and 1 o'clock every day. It may be 4 hours where you feel you're going to get the best benefit on any given trading day, depending on what you're trading, whether it be a trend or over a piece of data or whatever. Clearly, the time of day can change, but the time allocation is something that we should focus on. I think you'll feel energized across all those segments as well, because and feel you're doing the right thing. You've got the right balance. And the other good thing is, once you've got this nice solid base where you're effectively comfortable in your own space, it provides a great base for you to start setting future goals. And that's what we're going to move on to with the next slide, because I think it's very, very important. If we're going to do something like trading, we need to set ourselves targets. And, apologies, this is a bit corporate. Certainly things that I would have had to fill out every year, through my life, not just as a trader, but as a good corporate citizen. I was given, towards the end, we all had to write our own goals, and they had these measurables. They were specific. What do I mean? You know, we classify them as SMART goals, specific. So I just put a few examples here, and bear with me as I go through them. Laughable, I agree. A specific goal clearly is your line of profit. So there I've just thrown in, I want to make £1 million every week. It's good to have aspirations. I only want to trade 3 hours per day because that is coming from my wheel of life as such. That's the kind of time I need or can afford to allocate to my trading. I also want, as a specific goal, to start looking at multi-product trading. I don't just want to be sitting there and turning on my screen every day and just trading euro-dollar. I either feel, you know, that may be a bit one-dimensional for me. It may end up getting boring. And of course, the other thing about trading one single product is that there will be periods where it just doesn't move at all. And therefore, you have limited ability to take any money out of that marketplace. And one key thing there as a specific also relates to you as an individual. You know, I've just put there, I want to increase confidence and positivity. Now, is that confidence in my own trading capability? Do I need to increase my positivity when I'm in markets? And I think if you set yourself that kind of goal as well, that will be reflected in the rest of what you do in life. So, you know, something to do with yourself and your own psyche, I think is a good target as well. The key thing then is, are they measurable? Now, clearly, your profit and loss is measurable, is captured on a trade-by-trade basis, or we may want to measure it over a period of time. Time allocated is quite easy. We all have watches, clocks in our house. We have to be honest about this. And if all of a sudden the 3 hours starts creeping to 5 hours, but we're not still changing, you know, we're not changing our P&L profile or anything like that, we have to be very, very careful of that. So it's something we can monitor. It is measurable. And if it starts getting out of whack, we need to do something about it. Products traded, very, very easy. The key thing there around increasing confidence, you'll notice it in your mental well-being. If you're achieving something psychologically, if you're making your life easier, if you're more confident about things, you'll notice it in your well-being. So that's a good way of being able to measure that kind of target. Clearly, a key thing here is let's make them achievable. And for me, achievable and realistic, they kind of blur into the same. If we go to the first specific one, £1 million every week, yeah, clearly to man, you know, to the normal human being, that's just not achievable. So, you know, that's why I specifically put it there. We need to make sure these specific targets are achievable. And again, it's clearly not realistic to a mere mortal like us, or certainly myself. Is it achievable from a profitability perspective if we look at our track record? Now, we want aspirations in our targets for sure, but if we've only been trading and, you know, our bottom line has been roughly a couple of £100 per week, then putting in a target typically of £1 million every week is clearly not achievable, and we have evidence to prove that. So, you know, we've got things that can help back up these targets and whether they are actually achievable. And, you know, once you've looked at these, one key thing is you may have these aspirations, and so if they're not at this point in time achievable, you know, once we get into the swing of things and we've got a track record and we're building that confidence, etc., you then start asking yourselves, and you would only do this if you've got a target. If you don't set yourself any targets, then yes, you'll have an aspiration, but how do you achieve that aspiration? Because generally you have to change things, whether it be little tweaks here, little tweaks there, or sometimes some major changes to be able to achieve some of these more aspirational goals that we should set out for ourselves. And so that's a good reason why setting goals also forces us to go through this process of working out how do we change to be able to achieve some of these bigger goals that we want to set ourselves. So training clearly is something, you know, maybe coming on more of these webinars, going live onto the Sunday night webinar to look at markets, you know, a little bit more time invested to get a bit more out of it, you know, and clearly taking a bit of time on your desktop setup. If you want to go multi-product and you still haven't changed your desktop, you know, you're doing yourself a disservice. You know, you need more market indicators on your desktop if you're going to start introducing, you know, multi-product, whether it be, you know, you just only trade S&P at this moment in time. As soon as you start dabbling in some FX currency pairs or commodities or whatever, you need to make sure you get all that information on your desktop. So some changes will need to be made to start developing some of these goals. You know, clearly, am I in the right markets as well to achieve some of these goals? And one big thing there, is it a hobby or is it a potential career? You know, make your mind up on what this is, because clearly the amount of time spent, if it's a hobby and you put 5 hours a day, you know, and it's just a hobby, you know, for me, that feels a bit out of whack. For me, you know, that could lead you down a rocky road. So let's make sure things are aligned when we do these goals. And, you know, the final one around this is timeliness around it. And clearly, when we're trading, we have that ability to trade short term, to trade medium term, and obviously we have longer term aspirations, whether they be financial or you know, indeed moving it up towards being a potential career. So we can set ourselves some nice timely goals as well. So hopefully by going through this exercise, we put ourselves in a good place. We know what we're doing. We know how much time we should be allocating to get where we want to go. And very, very briefly, before we have some questions, we're great at Corellian. We truly believe in process and planning. And we just got this little diagram here, and it's a bit of a wheel, and it's a continuous wheel. We don't actually move just from one segment to another in order. This is continually going around as we trade. And this is part of our process. And we firmly believe if you get a process right, it will help you control your emotions. Again, you get a formula, you're working towards a formula, it's good for you, you feel comfortable with that, and your emotions become a lot more stable. Once your emotions are a lot more stable, bearing in mind you're in a pretty stressful environment, you know, it's going to help you make the right decisions in tough times. So we'll evolve this wheel over the next few weeks, but you'll see in there all the components that we believe need to be part of your trading process. And my very last slide is just to let people know, you know, when we talk about execution, and that was one of the segments of that wheel, for me, smart execution isn't just knowing when to buy and sell, isn't just pressing that button. Smart execution starts very, very early in your trading process, and you're already doing it in terms of, you know, listening to some of the fundamentals that Mo talks about in watching and listening to Richard in terms of, you know, getting a good handle on the technical analysis, because you need to use all of that, you read and you research, to produce a trade idea. And even if you're coming in and trading very, very short term and buying and selling, you should be trading with some idea sitting behind it of some form of momentum or direction of whatever you're choosing to trade, even if you're only trading and trying to take 10, 15, 20, you know, short-term points out of it. You have to trade with something behind it. So you're going to get this kind of trade idea, but the question, and this does come in very, very early in your process, is how do I put this idea into the marketplace? And the reason I'm bringing this up pretty early is that you do have choices out now. Now, I know some bring restrictions in terms of margin, etc., but these are out there, and sometimes you don't choose the right product to reflect your idea best in the market. It's something, as you get more and more experienced, these choices become more and more available to you. Maybe you got more confidence, but you know, sometimes it's very important right at the very early outset to choose the right product. One, hopefully if you do, then you're going to get the best opportunity. Secondly, it will save you disappointment. You know, if you constantly just go to one marketplace all the time to reflect various ideas, there may well be outperformance elsewhere that you should be capturing. And once you start looking at that, you don't want that frustration of finding out you're sitting in euro dollar when actually maybe Aussie dollar should have been the right currency to trade. So we've just got three here. You know, clearly these are products, and within those products you've got you know, various things that you can trade, but you've got stock indices, you know, whether you're regional in terms of, you know, the bellwether globally is the S&P, but you know, you could be looking at S&Ps, you could be looking at the DAX in Europe, clearly FTSE, etc. And then when you talk commodities, you know, gold is the one we would all go to if we look at commodities. As you look more at silver for, you know, slightly more experienced traders, copper, etc., liquidity disappears. You need to be careful. But these things are out there, and sometimes they are the right choice, and those choices are taken early when we look at execution. And clearly the ever liquid currencies always there do often provide many opportunities, because you have regionality, you have, you know, high liquidity, and sometimes they can reflect some great global ideas. So a quick insight, you know, next week we'll move more into strategy, short-term trading strategies, but hopefully if you do that exercise, it will make you a bit more confident that you're going in the right direction and setting your stall early to achieve some of those goals.
So
back to
thanks,
Chris.
Roger. Oh yeah, sorry. Thanks, Roger, and thanks to Morris and Richard as well. Some great content there. You heard Richard talking about the Sunday night webinar. That's something that Pepperstone provides with Corellian now every Sunday night at 7 o'clock. The next one is the 31st of January. Invites go out every Thursday for the following Sunday. So we had about 200 of you join us last Sunday, where Richard and Morris talked about strategy and technical analysis. We'd love to have even more of you join us this week. So you get on there first, because places are limited, but you register when the invite goes out tomorrow, and we'd love to see you on Sunday, where we can talk about the week ahead in further detail. So there are already some questions. Morris, we had 1 month into Brexit. What do you think the impact is on sterling right now? What's your assessment of that?
That's a good question. The assessment is that I think sterling has remained supportive, but I think a lot of that was a weaker dollar. I do think there was an initial influx into buying some UK assets, but to be honest, they've slightly disappointed. So I think there's still some teething problems with Brexit. I think there's some bottlenecks. There's some price increases coming through. And it's not a clean process. It was always going to take a while to get us through this, and there are some border issues sort of getting goods in, but it's flowing pretty well. Overall, I would say it's gone fairly well so far. I expect the allocations from global investors into UK, which I think is cheap, to start probably around the middle of the year, because I think they want to see how we come out of this crisis and how soon we come out of it. I think we will be rewarded if the UK comes out of this crisis before the EU, which is why I think euro sterling started to fall and things like that. But one thing I would say is that on a trade weighted basis, sterling is still very cheap, and I think that still needs to be reversed to some degree. And of course, the trade weighted is a basket, so I'm not sure it's necessarily against the dollar, but I think generally into the summer we could see the overall value, if you like, of sterling improve slightly still.
Okay, great, thanks very much. So somebody was asking, and I'll just pull it up on the screen for you. So somebody was asking about how Richard draws his Fibonacci levels, and what I'll answer for him, because he's had to pop off, so he's not able to just take the questions for us. But what he does is he will look at the significant low of a move and draw it from this. So in this example, this point here, and he'll draw it to the top of the move, and then that will give you the levels, or vice versa. You draw it from the significant high in this move to the significant low, and again, that gives you these levels here. So I hope that helps there. So significant low to the significant high, that gives you these levels here, and then vice versa, significant high to significant low, and then that will provide you with the Fibonacci levels going up. So that's that question. Hopefully that answers that question there. Morris, obviously the Fed press conference is going on right now, or just about to start, but what's your assessment so far of the Fed and what they're saying?
Yeah, right. I mean, basically, as expected, the Fed did nothing with rates. They maintained the pace of purchases on the treasuries, and the MBSs, the mortgage-backed securities, which we all thought they would do. So no news there. The only statement, there was a snippet that came out with it, and the only piece I picked out of that said that the pace of US economic activity and employment has moderated in recent months. So that seems to signal to me that the Fed's still not happy about this recovery, and so I'm not expecting them to sort of say a great deal as he gets started right now, in fact. So, you know, I think we need to get to watch what he's saying. He will be questioned about frothy markets and tapering, so let's see what he has to say, but nothing from the actual statement when they announced unchanged rates.
And just on that, we'll take this as the last question, then we'll let people go off and obviously listen to Powell, but what sort of comfort level do you think central banks, and specifically the Fed, would have with markets if they were to start selling off aggressively? You know, what sort of moves do you think they start to go, oh my God, you know, this is a bit nervous again? 5%, 10% from here, 15, whatever?
Certainly nothing we've seen so far. I think you'd have to see them down more than 10% for them to get. Again, it depends how quickly it happens, Chris. And I think, you know, it's all about pace. It's like inflation. If it drifts in, fine. It's like if these stock markets readdress and we do 2% day today, bounce a little bit tomorrow, 2% on Friday, you know, and then 2% on Monday. I don't think they have a problem with that. I think if we go 5% today and then 10% tomorrow, then I think they've got an issue, and they may just come out and say, look, we are committed to this. I'm not sure the Fed can do a lot more, but they are backstopping markets. So any comment from them would sort of suggest that they're there for you. But I'm not sure where what we call Fed put, if you like, what level we need to get to. But I'd say it would have to be a fairly quick move, and maybe 2 or 3 days of a fairly quick move as well.
Okay, so just last one, somebody put that in just as I was saying that. So what's your thought on, I mean, you obviously highlighted your sort of thoughts on what the Fed may or may not say. Do you think that he's going to remain the status quo, or do you think he could be slightly less dovish?
I think from that little snippet we had in the main statement, I think that basically he's going to sort of more or less stick to the script. So I don't think we'll see a great deal new. I don't think this is a policy statement meeting. You know, I think he's going to be pushed hard on tapering though, but I'm not sure he's going to do that. But there are signs in some of the markets that inflation is creeping in. But you know, he's already told us he wants to see a lot of that before he moves. So I think he's going to stand pat on this one.
All right, brilliant. Thank you very much, Morris, Richard, and Roger as well. We will be back in 2 weeks' time, but obviously we are doing the Sunday night every week. So we will be back in 2 weeks' time on a Wednesday, but we're doing every Sunday. So we hopefully see you Sunday. If not, we'll see you in a couple of weeks. Have a great time with the markets. All the best. Bye-bye.